Moving on to our second session of the day, and I'm very pleased to introduce the moderator of our next session on finance and investment. Professor John Ning is an associate professor of accounting, the director of the Center for Globalization of Chinese Enterprises, and associate director of the China Business Case Center at Tsinghua University School of Economics and Management. Professor Jia's research focuses on capital markets, venture capital and private equity, public offerings, and the growth and valuation of entrepreneurial companies. She is the winner of many awards, including the 2010 California Management Review Best Paper Award, the 2010 and 2017 International Conference on Asian Pacific Financial Markets Best Paper Award, and the 2013 CFA Institute Research Award. She is a leader of 2 World Economic Forum projects and several research projects that have been sponsored by the National Natural Science Foundation of China. Professor Jia has written more than 30 English cases on management practices of Chinese and non-Chinese companies across a wide spectrum of sectors. These cases including eBay, Checkpoint, Baidu, and many others. She is a member of the Ministry of Finance of China National Accounting Leaders Program and an active member of China's financial media. She is also the guest host of CCTV News' weekend program New Money and a guest of World Insight. She serves on the board of directors of several companies. Professor Jia holds her undergraduate degree from the University of Minnesota, a master's degree from Stanford University, and a doctorate in business administration from Stanford's Graduate School of Business. I'm so delighted to introduce to you our next moderator, Professor John Ning.
Thank you very much for that very kind introduction, Professor Duggan, and it's a privilege to serve as the moderator for this session. And good morning and welcome to our next session, which is finance and investment. As we know, China's financial sector is currently experiencing rapid growth, both in volume and in complexity. In fact, in the last year, we have seen some major changes, initiatives towards the opening of China's capital markets. For example, the inclusion of A-share in the MSCI index, as well as the contemplation of CDR. So we're hoping to invite some of our foreign-listed companies to relist back in China. And at the same time, we've also seen major entrepreneurial activities in the finance sector. And so what's the current landscape of China's financial sector? And what are some of the major changes and how profound are their impact on global investors, entrepreneurs, companies who are seeking capitals, and what does the future hold for China in terms of financial development? So to hear more insights on these very important questions, I'm delighted to have invited 2 distinguished panelists to join me on the stage. So sitting next to me is Dr. Fang Xinghai. Dr. Fang has more than 25 years of experience in China's financial sector. He is currently the Vice Chairman of China Securities Regulatory Commission, and prior to that, Dr. Fang has served as a Bureau Director for the Office of the Central Leading Group for Financial and Economic Affairs. Dr. Fang is also a Stanford alumni who holds a PhD in economics. And sitting next to Dr. Fang is our second distinguished panelist, Mr. Neil Shen. Mr. Shen is the founding and managing partner of Sequoia China, a top-tier venture capital firm. He's also a co-founder of 2 NASDAQ-listed companies. One is C-Trip, the other one is Home Inn's Hotel Group. And actually, Mr. Shen is the highest-ranking Chinese investor on Forbes Midas list for the years from 2012 and 2018. And in fact, back in this year, in April, he actually topped that list. So welcome, Dr. Fang and Mr. Shen.
Thank you.
So I think our session will proceed as follows. I'll ask some general questions to both our panelists, and we'll leave about 15 to 20 minutes at the end for open Q&A with our audience. Okay. So just as a way to start the discussion here, I'd like to ask each of you to provide our audience an overview of your key observations and insights on China's financial markets. So what do you see as the major changes in the recent changes, and how profound are their impact? So let's start with.
Well, before I start, I just want to say a few words about this conference. It's a great pleasure for me to be here today, and I've already met a lot of Stanford friends, but there are two people I particularly wanted to meet today. One, of course, is the president of Stanford University, Mark. I was sitting right beside him. Thank you for coming to this conference. The other is a professor from UC San Diego, Susan Shirk. Susan, okay, she's sitting over there. Susan is a really kind of dinosaur kind of expert in U.S.-China relation. In Chinese, we say 骨灰级的人物, 骨灰级的人物. She came to China in 1971 in the ping pong diplomacy. And at that time, she was, I believe, an undergraduate student at MIT. And she met Premier Zhou Enlai. None of us here, other than her, have met Zhou Enlai. Zhou Enlai is one of my most respected Chinese leader. And for that, I have a lot of respect for her. And welcome to China, Susan, at this critical moment of U.S.-China relation. I hope this conference today is the first one. There will be a second one, and third one, and fourth one, and so forth, because U.S.-China relation is so important to the fortunes of both countries, as well as the fortune of the world. And it's really incumbent upon all of us to do something about it. So this is the general remarks about this conference. Now, regarding the Chinese capital markets, I just want to say two things. One is that China has the largest piles of savings in the world. I did some calculation before I came here. Last year, in 2017, China saved 3.8 trillion US dollars. The United States saved 2.6 trillion. Right? So China has the largest pile of savings. And the financial sector is there to allocate that saving efficiently. Now, the Chinese financial sector, of course, is not that efficient yet. So we have not allocated that pile of savings efficiently. And in fact, we destroy a lot of capital in the Chinese economy. But despite of this destruction, the economy still grows at about 6.5%. And going forward, there will be more savings. So how do we strengthen the financial sector? To allocate that huge pile of savings more efficiently is really the challenge for the Chinese government. And one thing that we are doing earnestly is to open up the financial sector to the rest of the world, to bring in higher quality financial service providers so they can help allocate that pile of savings more efficiently. And if they can do so, the Chinese economy will grow even faster and more efficiently as well. So we are opening up in a very substantial way. You must have noticed that we got rid of this equity cap, right, for JV foreign securities firms and fund managers, as well as futures brokers. But in addition to that, we are also welcoming foreign long-term capital to come in and invest in the Asia market. The Asia market, of course, is under pressure right now. But in addition, but other than this sort of U.S.-China frictions, one major reason for the depression right now is that we don't have enough long-term capital in the Chinese stock market. And we are bringing foreign long-term capital in this market. So this is one thing we are opening up substantially and thoroughly, and we are going to do this opening up as fast as we can. The second point I want to make about the Chinese capital market, as well as the financial market in general, is that if you look at China over the last 40 years, Chinese manufacturing has really transformed the landscape of the world economy, not just the Chinese economy, but the world economy. Now, looking at the next 10, 20, 30 years, I believe the manufacturing sector in China, of course, will continue to play a very important role, but the financial sector has the potential to transform the landscape of world economy. Just as the US financial sector transformed the world economy during the last century, and in this century, the Chinese financial sector has that potential. The potential is so big. So we are really, working in the financial sector right now in China. We are really excited, and we want to work together with all our friends from around the world to make that a reality. Thank you.
Great, thank you. So we'll have more detailed questions later on, but Neil, I want to sort of hear your thoughts on what are some of the major changes that you see in China's venture capital and entrepreneurial sectors?
Well, first of all, I'll start by saying that I'm very honored to be here, and especially that unlike Dr. Fang, I'm not a Stanford alum, so I'm extremely honored here. But obviously, I'm very proud. I'm a proud parent of a newly Stanford undergrad. So that's helped me to make the connection.
Wow.
Congratulations.
So come to the capital market. I think on the public side, I would say a lot has been done in the last several years. I mean, obviously, much credit to people like Dr. Fang. I think you now see increasingly more number of high growth tech companies, but maybe with loss making, come to the Asian market, which I think is great. If you look at China as a whole, if you're looking at 10 years ago, almost every single tech company end up listed in the US. And that's not should be the way it should be. Most of companies should list here. And because people know the business model better, many of those internet companies, counts Chinese customer as its major user base. So why not here? And so I think the CSRC has done a great job in attracting those tech companies coming back. So that's, I think, point number one. Point number two, I think on the private side, I think we can have done more. There clearly, fundings, goes to the wrong places, P2P or real estate or some over-leveraging, and if you're looking at the long-term capital, which Dr. Fang was referring to, we need that long-term capital base to funding the real economy, and the limited partnership base in China is still very underdeveloped. I mean, we don't have endowment like Stanford. We don't have corporate pension. We don't have big, charity foundation who become a major source of funding for long-term capital for alternative investment in the U.S. And we really need to develop in that base to helping the money channel to the entrepreneurs through the most effective way.
Thank you. So based on your comments, so you both mentioned the role of capital markets. One is, we're gradually opening up and actually opening up more and more. And then you also mentioned the importance of capital markets to fostering entrepreneurial activity, especially alleviate that fundraising issues. Now, but with the gradual opening of capital markets, so what does the future hold? I mean, what's the future role of Chinese capital markets in supporting our own tech companies or startup companies? Because as Neil mentioned, actually for many years, Chinese startup companies go to foreign capital markets for financial needs. But now, with the CDR and all that, so how will that change the current landscape?
I agree with Neil. I think, most tech companies should have their primary listings inside China. Mm-hmm. They, of course, can have a secondary listing abroad. And that's how, it's done in every other country. So there's obviously some problems with our capital market in China, because giving a choice, if our capital market is performing well, if it welcomes the tech companies, I think most tech companies would like to list domestically, right? So clearly there's something that we need to improve upon, no question about that, and we are doing it. Neil mentioned it. I must admit that we have not done enough, and we need to speed it up. I've already talked to a lot of tech entrepreneurs and investors in this room, and since I've been newly assigned the task in the CSRC to oversee the IPO and the secondary offering function, I can pledge to you that I will double my effort to make sure that our capital market is hospitable to the Chinese tech companies in a short period of time. China, as I said, has a huge piles of saving, right? So we don't need to input foreign capital to fund the domestic tech sector. So if we can, improve the capital markets, the domestic tech sector should grow much better. But of course, we still welcome foreign capital. Let me make that point here clear. We still welcome foreign capital to come into China to invest in the tech sector and in other sectors because there's a term mismatch I just mentioned. China has a huge piles of saving, but that savings stay in the commercial banking sector, right? In terms of deposits and wealth management products. But commercial banking is a very bad instrument for technology growth. Capital markets is the right instrument. So there's term mismatch. We need long-term capital, and secondly, we also need foreign capital in the sense that they have special expertise in certain areas. They can identify certain tech companies much better than Chinese domestic capitals. But anyway, the point that I want to make is that we do have to improve the domestic capital market in an urgent way to make sure that our capital market can serve the growth economy, the technology growth of the Chinese economy.
Yeah, I think it's, I'm pretty sure CSRC has a lot of, plans to further promote the technology company to get listed here. The CDR efforts are definitely one of the major measures. And the other angle I want to talk about is, Hong Kong is part of China, and a very important part of the China financial market, in my view, and it could be a good complement to what we have in the domestic market. And if you look at Hong Kong Stock Exchange, a great change has been made in the last several months. Obviously, that's accumulation of many years of efforts by the leadership. And that means the high-tech company, if somehow you're not best fit for the domestic market, you can go to Hong Kong. And I have to give a lot of credit to the Hong Kong Stock Exchange because Hong Kong become the only market in the world, other than US, which entertains biotech companies in a substantial way. And I think this is very, very, I think timely because life science and biotech is has been done, has really up and coming in China in the entrepreneurial arena, and we see some great companies being built in that sector. So I think this is all coming together in the very right time.
That's great. So as Dr. Fang mentioned, we're opening more to long-term institutional foreign capital, and we want to attract their attention to the Chinese market. But I think another related question is, attracting them is not enough. What does it take to make them actually stay in China? Because some foreign institutional investors may be concerned about the governance, for example, of our listed companies, and the standards are different. The accounting standards are also slightly different. So what does it take to actually make them stay?
Yeah, it's following one point on what Neil said before I answer your question. I also applaud the effort by the Hong Kong Stock Exchange to attract tech companies. And they've done a lot of work that the CSRC and the domestic two exchanges can learn from. So we welcome the development in Hong Kong. Now, to your point, right now, a lot of foreign capitals, they're very interested in China because the size of the economy, right, the growth rate, the innovation, the human talents and so forth. But at the end of the day, these foreign capital, they have to make money to stay here, right? So if they lose money consistently, they're going to leave. And for them to make money in accordance, corresponding to the rapid growth of the economy, I think we have to make the capital markets, particularly the stock market, a lot more competitive in a sense for listed companies to acquire capital. Listed companies have to compete for capital. Then they will become efficient. Then investors can, make money, can have a reasonable return. Right now, the listed companies are operating in an environment where they do not have to really compete, right, so hard for capital. And this is something that we have to improve upon.
Okay, great. So, and also as Chinese capital markets is opening up, that also means where the financial ties among countries, among capital markets is getting stronger than ever. So that also means that China is facing a stronger exposure to the systematic risk. So how do financial regulators from different countries can potentially collaborate with each other to precaution this systematic risk and to work together to improve the overall fundraising environment?
There are two things that we have to do. One is that you make sure, as a regulator, you try to make sure that your own market does not become a bubble, right? Does not create too much risk. Because the risks in any major market nowadays inevitably spread into the rest of the world. So, no, but of course, some people will say, as a regulator, you should not care about the level of the market, right? The valuation of the market. You just regulate the information disclosure, blah, blah, whatever. I don't think, I disagree with that. I think history has shown that regulators and government authorities, the central bankers and so forth, do have to pay attention to the valuation of the various markets, because you cannot afford to have a huge bubble and then the bubble collapses. The devastation it causes is so huge, particularly in this globalized economy. We cannot afford to let that happen again. But secondly, the regulators in different countries and different regions do have to cooperate much more closely. So I'll give you an example. The CSRC and the Hong Kong SFC, we just signed a memorandum of understanding on regulatory cooperation. So for example, if something extreme happens in Hong Kong or in mainland China, the two regulators are obliged by this MOU to share information on a very timely basis and to answer each other's request in terms of regulating certain market players in a very quick way. And so far, we've been cooperating with the Hong Kong SFC very well. And in fact, the chairman of the Hong Kong, not the chairman, the CEO of the Hong Kong SFC told me that according to him, that this existing MOU between the CSRC and the SFC is actually the closest cooperative MOU among all the regulators in the world. Now, of course, Hong Kong and China are very different. The relation between Hong Kong and China is very different from other countries. But this is the spirit. We are moving toward a much more cooperative international regulatory environment.
So let me ask you a slightly more broad questions because with the rapid development of China's financial markets and innovation in the financial instrument and more venture capital going to consumer financial services, some people are concerned that the Chinese economy is gradually shifting away from the real economy. So what's your take on that? Are you worried?
Maybe Neil, you can answer that. Are you shifting away from the real economy? Are you engaged in this?
Well, clearly there's more, could be done, right? But, if you're looking at our long-term capital, which is supporting the economy, I think we need more funding going to alternative investment, venture capital and private equity, for sure. I think they're really supporting the real economy. And many actually goes to the new economy, which is even better. What could be improved, in my view, is on the banking side, on the commercial banking side. If you're looking at general sort of lending mentality of most financial institutions, they tend to be favor the large company, which I understand because the risk profile. But then if you look at US, for example, there is a substantial lending goes to mid-tier company or even small companies and startup companies. And Silicon Valley Bank, for example, are very good example of that. So I think we need to encourage the banks to taking obviously calculated risk, but at the same time more open to lend based on credit and cash flow instead of traditionally lend based on asset. I think that is a new approach. Hopefully the commercial bank is going to adopting to further channel the money go to where the real action is taking.
So Neil, since you mentioned that venture capital money is now going to a lot of new economy companies, so I happened to actually read a Deloitte report that actually provided some statistics on the industry distribution of unicorn companies both in China and the US. And what's interesting, but perhaps not too surprising, is the fact that Chinese unicorn companies are actually they're concentrated in like entertainment, culture, transportation, and so basically service sectors. Of course, these sectors provide tremendous amount of new opportunities for business model innovation because they're trying to meet the upgrading demand of the rising Chinese middle class. But that also raises the concern that does China have real sort of deep tech innovation, because some people are saying, we haven't, in the past, last decade, we haven't invested enough to support fundamental and scientific research. So what's your take on that?
Well, again, I think more, definitely more should be done on converting lab research into real life solutions. That's for sure. And clearly the US university like Stanford has done a fantastic job in doing that. But if you look at China, the so-called unicorn being created or substantial company created, right? Yeah. We need to put things into perspective. In China, most of those coming from consumer internet. And in the US, much smaller percentage comes from consumer internet. Part of the reason is that if you look at Silicon Valley the last 5 years, the reality is we don't have many new company created become substantial. It's a reality, whereby in China we have a bunch of companies have been emerge and become, substantial, commercial leaders, Toutiao and Pinduoduo and so on. These are all like the last 5 years, right? So from that perspective, China is ahead of the game. So when you, looking at data from that perspective, say, wow, China has 70% and 80% coming from consumer internet. First of all, consumer internet are not necessarily deep tech, but they are innovations, which is something which we care the most. The fundamental question is, are we having real innovations? And the answer is yes, right? The very reason, Toutiao becomes so dominant because the algorithm and, the artificial intelligence applications where you get the best user experience. So you can scale and you can dominate. And technology associated with that, of course. But it's just technology applications. They might not be able to IP that, but that's definitely something which we very like to see. This is really real life, innovations. On the other hand, I think there hasn't been much sort of probably media coverage on the so-called hardcore technology side. But there are a long list of that. I mean, how Huawei continue to innovate, 5G, etc. CATL, right? I mean, a company just listed, right? I mean, this one of the top 4 battery company in the EV space in the world. And we got DJI, which dominates the consumer dual market, more than 80% market share. Those are all homegrown, as you call it, deep tech companies. And probably they've been a little bit too low profile compared with the large consumer internet company. They have not been took big notice from the media, especially Western media, which we should probably talk more about.
Right.
Yeah.
So,
add one point. Finance does have a tendency to veer off from the path of serving the real economy. They tend to get into a situation where money creates money, right? They're just forming like, a self-circulating kind of cycle, and they're benefiting themselves. They're not really serving the real economy. And the Chinese government worries about that constantly. So we always say, the financial sector should serve the real economy. Now, on the other hand, as Neil just mentioned, there are a lot of companies that are supported by particularly the VC and PEs. You cannot tell immediately whether they are really serving the real economy, or they may have, whether they have the potential to do so or not. You mentioned Jingzi Toutiao. I guess to a lot of top Chinese leaders, they think this is a trash company. It's just not worth anything.
We'll try to make change the impression.
No, I want to caution that because every government regulator has a very limited amount of knowledge, right? And we're not always at the cutting edge of technology. So as a regulator, we have to behave in a kind of modest way. Right? You cannot, sort of extend your hands too long, right, to try to crack down on everything. But on the other hand, there are something that we see and we can pretty much ascertain that it is not good for the real economy. Then we have to crack down on it, right?
Absolutely.
If you see a clear bubble being formed in the stock market, we have to do something about it. We cannot just stay there and wash your hands and say, let the market take care of itself. That's very irresponsible. And a recent example, which I support, is the Chinese government's attitude toward cryptocurrency, right? Now, there's a lot of debate even within the government. Should we let cryptocurrency, continue to boom in China, or should we crack down on it? But after careful analysis and balancing the risk with return and different types of risk and returns, the Chinese government decided to sort of crack down on this activity. And I personally support it. So this is an example where when at some point, sometime the government does have to act. Right, it does have to act, but you have to do it in a, I guess, careful and modest way.
That's right. So, you mentioned that you actually have a very unique background because you've been a very successful entrepreneur now as well as a successful VC. So in your view, how does the role and dynamic of VC has evolved over time in terms of helping startup companies to succeed? And the reason I'm asking is some academic research, both in the US and in China, one of mine own included, actually finds that in the early days, VC-backed companies actually tend to underperform non-VC-backed companies, especially after the IPO period. But more recent statistics actually show a reverse trend. So in your view, what's able to explain that changing pattern?
Yeah, that's probably even more relevant in China. When we started the RMB business back 10 years ago, I look at the terms that limited partner like to have. I feel like I'm going to be in a very difficult business because the unsophisticated LPs were asking 5-year terms or 7-year. How you are able to really support a startup company if you only have 5 years for your fund? We are talking about 100-year enterprise, 100年老店, but at the same time, you're going to be get out completely in 5 years' time. That's a mismatch of interest. So I think, we push very hard, but I'm obviously, in the early days, I'm not 100% happy. It's an 8-year fund for our first RMB fund, but now getting to, 7 or 8 years now, we have over 10 years fund cycles, which is great. And I think investors have taken a very long-term views together with the founders, and that's the only way you can help them to build a company. And I hope that obviously founders have a really long-term view, 50 years, 100 years, that kind of building a long-lasting enterprises. And that's how value gets created, and that's how I think the pillar of the economy gets built. And that's why I think you can probably continue to outperform the market even post IPO because they have a long way to go.
Mm-hmm. Right, and also I think recently, actually, just last few months, the government has enacted a number of new policies on fundraising criteria. So, who is qualified as a potential LP? So I think the general trend is moving more towards institutional investors who are willing to commit long-term to the startup companies. But what's also interesting is if you see the changes that's happening in the internet space, what really started as a blue ocean is now becoming a red ocean. So we have A and T, right, Alibaba and Tencent, and some much smaller startup companies are actually saying, well, now it's actually very, very difficult to find its own position and growth opportunities. So do you think having this duopoly, if I may use that word, of A and T, is it really beneficial to the overall entrepreneurial ecosystem, or is it more detrimental?
Well, the whole industry has been developed for more than 18 years now. So naturally, there will be substantial player. There's no different in the US. You got the big five, whatever, call it big five, big six, right? I actually argue, we have a better chance for the younger startup company to break out and become substantial company. If you look at US, again, in the last 10 years, again, not to blame Silicon Valley, but how many $50 billion market cap company has been created? Zero, almost zero. I mean, Uber probably is on the borderline. Here in China, we got, though they still have a lot of controversy here and there, you got Didi, you got Meituan, you got Toutiao. And then beneath that, you got another long list of companies which has been, you can argue that they take market share away from the very top players. Though, Ali and Tencent has done a fantastic job. They continue to maintain their core competence. But I think I would say this, if you are in China today, you have a better chance of building multi-billion-dollar market cap company. Look at the US, right? If you look at Instagram and WhatsApp, every major innovation has been stabbed by the major dominant companies. So I think in that field, I think there's a healthy competition. Let's put it this way.
Okay, healthy competition.
Good.
Okay. So in terms of like entrepreneurial ecosystem, what do you see as major similarities as well as differences between U.S., say Silicon Valley, and China?
Well, I think coming back to funding issue, because we're talking about finance and investment. If you look at the U.S., they are very sophisticated LP base. As I mentioned, pensions, endowment, and so on and so forth. Here, I think if you look at the R&B space, actually government play a role, and I think it's a very, very important role. Many of those, a government-funded fund of fund has contributed quite substantially to the whole funding environment in China. Especially now, I think we're seeing deleveraging from the banking industry into that sector. Now, I think that's probably even more important role, which I think is good because they can bridge a long-term funding into the hands of hopefully smart managers, and they can obviously allocating capital effectively to the real entrepreneurs. So that's I think at least something different, and I think like I said, I think I would like to see more so-called deep tech converted from university, from research lab into real-life solutions in China. And I think the US has done a fantastic job. Universities know how they should be linked with the industry players, how to commercialize those assets. In China, I think we're beginning of the process, and we just need to get better at that game.
So do you think this is something, the conversion, more innovation coming from the universities, do you think this is something that the commercial private sector is able to support, or this is something that the government should take the lead?
Well, I think if you're looking at many sort of efforts, the government has adopted, I think it's helpful. But at the end of the day, it really should be the commercial sector taking the lead and driving. I'll give you a good example in the biotech area, right? And I'm pretty sure there's a lot of IP associated with the top university here in China. And it should be the entrepreneurs who reach out, who understand how those assets could be, commercialized, whether it's genetic, solution, it's gene, editing or gene sequencing solutions or new drugs, and they should reach out and work with all the universities. I think universities should encourage and have the policy to, for the professors to able to spend some efforts to work with the, the business world with the entrepreneurs. But I don't think the government needs to be the driving force behind it.
So you mentioned that private sector may be able to do something here, but then it goes back to our investment duration misalignment problem, right? Because the venture capital firms are under significant pressure to exit. In the US, it's 10 to 12 years. In China, significantly shorter duration. So for biotech, that research and development process can, potentially take up to like 10, 12 years. So how is the private sector able to support that?
Yeah, like I said, I think things has been really changed dramatically in the last 10 years. Today, there are many funds like ourselves who really has almost an evergreen type of fund cycle, and we can look at the business on a very from very long term, including I think on biotech. And thanks to Hong Kong Stock Exchange, now those biotech can go to the market. Obviously, after many years being incubated by the venture capitalists, they can go to the market with no revenue and with actually no revenue even for the next couple of years, but they could achieve a market cap, a fair market cap, and they also were able to get, additional funding to support them to, really commercialize the product and finally deliver those products. So I think we got a good ecosystem now building, between the angel investors, the venture capitalists, all the way to private equity and all the way to public market. That full circle has been established.
Okay, great. So I want to ask one last question before we open up to for the audience. So you just won you just topped the Midas list this year. What does this achievement mean to you, and what's your next major milestone?
I think obviously we do care about ranking, but probably we care less about ranking. I would say I pay a lot more attention to two things. One, how our fund performs, and what is my return to our limited partners. At the end of the day, they are customers, they are my boss. And I think that's it's the most critical KPI for me. I think point number two is at the end of the day, the success of a fund is how much you impact on you have made in the industry. Look at Sequoia. The reason why they've been had such an impact on Silicon Valley is if you look at last 45 years, if you look at top 10 or 15 company market cap created, those long-lasting carrier-craft company, Sequoia was responsible for anywhere between 50 to 60% of them. What's its Google, Apple, Cisco, Oracle, etc. Same for China. I think for me, the most important measure is if there's 10 top companies can be created in the next 10 years, can we own 40, 50% of that market share? If we can do that, I think that's probably what's the most important sort of KPI I would like to articulate.
Well, thank you very much for your insights. And I think we have some more minutes, so I'd like to open up to our audience for some additional questions. Yes, I see a hand over there.
Thank you for the chance. And I actually work at the SRC, but just to clarify, I didn't asking questions for Mr. Fang. I asked the VC chairman, is there any question that I should ask? He said, you can ask any question you want. So I'm gonna exploit the chance and asking two questions. So the first question is for two guests. Just now we were talking about encouraging technology companies to come to get listed in mainland China, but there's apparently conflicting issues like in mainland China, we always require the companies to show they have like 3 successive years of being profitable. But for many companies, like technology companies, even though their market cap is already pretty big, they're still, as we can say, burning money and did not meet our in mainland requirements to be a public company. So if we compare this to be like a relationship or a marriage, who do you think would change more to adapt the other counterparts? Is it the regulators or the big companies? And the second question is that I always want to ask Chairman Fang, because we are staffing working towards China, Shanghai and London Stock Exchange, and we are working day and night on that. And this topic is not mentioned here during the discussion. So the question will be why we have to accomplish this stock exchange within this year? Why this critical moment, and why UK?
Yeah, no, so you can tell she is not my tour.
Tough question for you, huh?
On your first question, I think we have to change. We have to change the rules for listing in China to make sure that good companies, tech companies, even though they do not have profits yet, can be listed. And this is a step that we have to take. There's just no way that you can kind of circumvent around it. Companies, of course, can go to Hong Kong, but that's not enough, right? And the Hong Kong market is significantly smaller than the domestic market. So we want to make sure that in the future, tech companies, even though they do not have earnings, they can go to the market. Investors can make a judgment. They can make a choice. On your second question of Shanghai-London Connect, this is just to introduce enough high-quality listed companies in the Chinese market so that our investors can have the access, can buy higher quality companies. As I said, in China, we don't lack money. Right? There's enough money there. We lack enough high quality listed companies. So the Shanghai-London Connect will resolve that will help to resolve that problem.
More questions? Yes.
Thank you for the opportunity. I graduated from Stanford Business School in year 2015, and now I manage a venture capital firm based in San Francisco. So I noticed that over the past 3 to 5 years, venture capital investment in China grow significantly, and now probably $40–50 billion deployed in China. And in the meanwhile, in the Silicon Valley, it's similar, $40 billion deployed annually in China. But in Silicon Valley, but in China, probably half of that, or significant part of that, are actually funding from the U.S. In the meanwhile, probably for the $40–50 billion investment in the Silicon Valley, only a small percentage of that probably come from China. So I'm curious about your view about your Chinese money investing in the U.S. In the early stage, in the later stage tech companies, and would you think that would be the trend of the long term? Thank you.
Yeah, I think there's diversification, sort of requirement for many Chinese asset managers, and naturally that if you want to achieve a great return, and I think Silicon Valley is a good place to, looking for that type of innovation and technology player. But meanwhile, I think we should looking at the managers instead of the funding sources, right? If you're looking at in China, most of the player, whether they have US dollar funding or have RMB funding or have both, they are on the ground teams who people have been homegrown. In fact, if you look around, the venture capital space and private equity space, the faces are very similar, familiar with me because they had been in the business for the last 20 years. So I would say, it's great that the Chinese manager reach out to, check into Silicon Valley, but I would say, we need to be cautious because I don't know whether you can make an impact or whether you can really pick in the very best company in Silicon Valley because there's some great managers who have been, there for the last 20, 30, 40 years, and whether you can do a better job, helping the local companies to sort of achieve their scale. I do recognize there is a cross-border possibilities. Today, many young companies founded day one with probably both US and China as their addressable market. So that's where probably those cross-border money can play a more important role.
Great. More questions? Yes, please.
So speaking about a cross-border role with restrictions on both sides of the Pacific closing regarding access of each other's technology into each other's markets in different ways, which will we see first? A Chinese internet company take a #1 position in a US market, or a US internet company take a #1 position in the Chinese market? Or will we never see it?
Maybe I'll just make a quick comment. I think depending on which sector you are, right? If you're looking at consumer internet, fundamentally it should be a local business. I would never imagine, frankly, maybe I'm too old, old-fashioned, that a U.S. company can do a great job in China and occupy a substantial part of the the pie because it's local. The business is very local. But on the other hand, if you look at some business which is more global, scalable, then we're talking about a China company could actually be very successful in the U.S. and vice versa. In fact, we can argue that Qualcomm has been a dominant player in China. NVIDIA has been a dominant in China in the respective area. And look at China. DJI, the company in Shenzhen, in that IoT space, right? Because that's a drone, that's a hardware. Space in Shenzhen, 40% of the market is in the U.S. They're the #1 commercial drone company in the US and on global basis. In fact, China is only a quarter of this total revenue. So in those areas, you would not be surprised to see U.S. company dominating China and Chinese company in the future dominating the U.S. if we do not see a major trade war happening.
Yeah, I want to add something to that. I think in today's world, no country can be self-sufficient in any area. So in technology, same thing. The future relation between U.S.-Chinese technologies, I think will be a kind of mutual dependent situation. What the Chinese government, since I work for the government, so I have a little bit insight into that question. What we really cares about is what we call national security. And in China, national security also means the control of the control of the flow of certain information. So whenever it comes to sensitive information, the government wants to set some kind of rules regulating that flow, and that can be interpreted as somehow erecting a war against U.S. companies, which I don't think that's the case. As Neil mentioned, in Qualcomm, in Apple, in all these areas, we don't have real restrictions, but maybe for Google, there's some restrictions, and increasingly, you see the same kind of things being played out in the U.S. against certain Chinese companies. So this is an area that it's quite complicated, and each country has, I believe, has legitimate concerns, and we need to sit down and really discuss about it.
Yeah, maybe I can add on to that. I think, the trade war today is all about physical goods, right? But to me, today and in the future, the most important asset to every country in the world is its data. I mean, in the digital world, data is the most important. We have United Nations governing many of inter-country sort of affairs, but I haven't seen, and I guess there'll be many years before we're able to see a United Nations rule on data exchange and data sort of trade, so to speak. And before that came, indeed, many of those artificial intelligence development is going to be lag behind what it should be. Trade war is to me, it's the more traditional part. But I think if we're looking forward, the data part is the most critical part.
Interesting.
Okay, I agree.
Great, thank you. Other questions? Yes, please.
Okay, yeah, so I actually have agreed with Neil, so I actually have two questions. The first question is that, I see successful companies like DJI, like Pinduoduo, actually many of them are here today. And then I see some of my personal friends like Ele.me, like Mobike, they're all being taken out left and right by the BATs. Right, so number one, I think the first 10 years and the next 10 years may be different, and I was wondering what Neil has to say about the next 10 years in my opinion, maybe a rougher competitive environment for tech startups. Right, my second question is maybe for the entire panel is that I see a lot of opportunities in transformation of, I would say, traditional enterprises. I actually personally represent one myself, Homelink Group, Ning Jia. Right, so we actually do a lot of innovations, right, a lot of technology associated with this, but it's actually very, very hard for us to get recognition that we are actually no longer a traditional company, but we're trying to become a tech company. We're trying to build platforms. We're trying to actually solve certain problems within the society. How do companies like us get more support, right, from either the chairman, the commissions, or from the capital markets as well?
Well, what is the second question? I did not get it. What is the second question?
The second question is that, in general, right, there's more, I would say, traditional companies trying to transform into technology. And then these companies are generally not recognized by the Securities Commission to, even if they have profits, to list properly in China. And it's actually very, very difficult for us to change and improve. And that's actually my question.
Yeah, maybe I'll start the first question. I think Yeah, I think the next 10 years, the competition clearly will get fierce, in so-called consumer internet sectors, and also obviously in the enterprises. Now we're seeing some bigger player emerging. I think ultimately you need to have a more differentiated product and technology. I think to me that's the most critical successful factors, and it's more important today compared with back 10, 20 years ago, because copy or copycats is no longer something that the people can sort of hope for that this is going to become successful. These two words are no longer linked together. You really need to have some original idea on business model, and you have some original product. If you look at all the substantial company being created in the last 2 to 3 years, that's already carried that pretty strong characteristics. And I will imagine that will continue to sort of be the case for the next 5, 10 years. And coming to just a little bit comment on the second point, I do think the next stage, there are a lot of great opportunity for offline company or traditional company to take advantage of technology, and enabling technology available for them to become internet smart players. And so it's no longer difficult to say, oh, this is an internet company or this is a offline company, right? Your company, if I remember the name correctly, is HomeLink, right? So are you an offline company? For sure, you started that way. You still have a lot of stores around the country, but you have a very strong internet presence. You have a app which reaches out to many new customers. I think that's the way that it goes, right? If you're looking at today consumer product, it's almost a omni-channel approach, no longer just like, oh, online channel only or offline channel only.
So just to follow up on that, so do you think for these companies, offline companies that are in the traditional industries, when they are trying to transform into sort of online presence, do they have an advantage or disadvantage? Because some people say that these traditional companies, they lack the gene to actually become this internet smart companies. So what do you think? You
raise a very good point. It doesn't matter how many stores you have offline. The question is, do you have a internet gene? You have internet DNA. If you got that.
But what is that? I mean, what is internet?
Technology, information technology. I mean, if you're looking at every single offline companies, traditional company, they are at a different level of sophistication of technology applications. I'm talking about information technology. Mm-hmm. In the old days, you can say, oh, I just call IBM, I call Oracle's, and then, let them develop a solution for me. Mm-hmm. To me, that's outdated. We are talking about the, ICE, right? I don't think it's a government policy, but in reality, I tell my portfolio company, we should looking at a true ICE because they're not able to provide the best solutions. You should looking for new solutions, new enabling technology. Maybe that's coming from Alibaba, that's maybe from Tencent's mini programs. And these are the new tools, new technology tools you should utilize and you should leverage on.
Great. More questions? Yes, yeah, all the way there, yes.
Thank you. My name is Ken Wang Xinze. I was a PhD student at Stanford. I recently founded a deep tech startup called Coherent AI, 和任科技. We're actually very proud to be part of the Sequoia portfolio. So thank you, Mr. Shen, for deciding to invest in us. But my question is actually for Chairman Fang. A couple of days ago, I noticed that Prime Minister Li Keqiang said he would support pre-profit deep tech companies to go for IPO. Do you have any more detailed explanation for that one sentence?
Working in the government, you carry out the instruction from the above, right? So if Prime Minister Li Keqiang has already said that companies without profits can be listed, we will make that happen. And it takes a little while to change certain rules, right? But it should happen. And my own preference is that for that to happen as soon as possible.
That's great.
Thank you.
More questions from the audience? Okay. So I guess in the interest of time, I'd like to actually close this session now. So And I'd like to thank Dr. Fang and Mr. Shen again for their insights on these very critical issues. But I'm sure these are all very broad questions, and there will be many more changes down the road. So hopefully at the next forum, we'll be able to discuss more. So thank you both, and thank you very much.